Welcome to Safe Simple Sound Podcast. I am your host, PK. Today we have an exciting episode lined up where we use AI voices to bring insightful discussions to life. But before we dive in, please note this podcast is for entertainment and educational purposes only and does not constitute financial, legal, or professional advice. Investment decisions should always consider your personal circumstances, financial goals, and risk tolerance. Be sure to consult a qualified financial professional before making any investment decisions. If you would like personalized guidance, you can reach out to me at savesimplesound.com/contact. Now, let's get started.
Welcome back to Safe Simple Sound, everyone. We're starting a new series of episodes about stock ownership with Sam, our expert, and Taylor, our eager learner. Stock actually is a piece of a company. Taylor, what's been on your mind on the topic of stocks?
I'm starting to see how owning a stock is like being a tiny business owner, but without the day-to-day headaches. This claim on earnings thing, dividends, is really intriguing. It's like getting a little paycheck from your miniature business. But how do those dividend payouts work in practice? And is owning just one company's stock enough?
Great questions, Taylor. Sam, can you shed some light on dividend investing and the concept of diversification?
Absolutely. Dividends are essentially a share of the company's profits that are distributed to shareholders. Not all companies pay dividends. Some reinvest profits back into the business for growth. Companies that do often pay them quarterly, and the amount is determined by the company's board of directors. Think of lemonade stand, for example. If the stand makes a profit, you as a part owner might receive a portion of that profit as a dividend.
So if I understand correctly, dividends are like a bonus for owning the stock, on top of any potential increase in the stock price.
Exactly. Now, to your second question about diversification. Putting all your eggs in one basket or investing in only one stock can be risky. If that company performs poorly, your entire investment could suffer. Diversification, spreading your investments across different companies and even different asset classes, helps reduce that risk.
It's like having a variety of lemonade stands, right? Some might sell more lemonade than others depending on the weather, location, and so on. But overall, your chances of making some profit are higher. Let's look at Maria's scenario, for example. She's retired and invested $10,000 in a blue chip stock. That's a stock from a large, well-established company with a 4% annual dividend yield and a plus or minus 5% annual fluctuation.
Okay, so a 4% yield means she gets $400 per year in dividends?
That's right. But remember, stock prices fluctuate. The scenario mentions a plus or minus 5% annual fluctuation. This means her initial $10,000 investment could be worth anywhere between $9,500 and $10,500 after a year, in addition to her dividends.
Exactly. So even though she's aiming for that steady dividend income, the overall value of her investment can still go up or down. What are the potential upsides and downsides to Maria's approach, Taylor?
Well, the dividends provide a consistent income stream, which is great for retirement. But if the company's stock price consistently drops, she could lose money overall, even with the dividends. Also, by investing in only one company, she's not diversified, right?
Precisely. While blue chip stocks are generally considered less volatile, any individual stock carries risk. A more diversified portfolio would likely have mitigated some of the potential losses if that one company underperformed. Maria's strategy focuses on dividend income, which is a valid approach, but diversification is crucial for long-term financial health.
Let's recap. Dividends offer a regular income stream, but they don't eliminate the risk associated with stock price fluctuations. Diversification is key to managing that risk. Let's dive into a practical scenario involving IPOs, tech stocks, and market downturns. Taylor, Sam, are you ready to unpack this?
Absolutely, Alex. I'm particularly interested in this because we discussed how stocks represent ownership in a company, but an IPO feels a bit more mysterious.
IPOs, or initial public offerings, are essentially a company's debut on the stock market. It's when a privately held company first offers shares to the public. It's a way for them to raise capital for growth, and for investors, it's a chance to get in on the ground floor.
Great point, Sam. Think of it like a grand opening of a new store. Everyone's excited to see what they have to offer. But just like with any new venture, there's potential for both great success and less than stellar performance. Our next scenario highlights that very point. Our hypothetical investor, from who is familiar with lemonade stand example, has decided to jump into the world of tech IPOs.
This reminds me of what we discussed in previous episodes about risk tolerance. Is an IPO generally considered a higher risk investment?
Exactly, Taylor. IPOs, especially in a volatile sector like tech, can be high risk, high reward. They often attract a lot of hype, but the company's long-term performance is still uncertain.
Our scenario details Alex investing $5,000 in a tech startup IPO at a price of $20 per share. So he bought 250 shares. Unfortunately, the market didn't react as expected, and the tech sector experienced a downturn, bringing the share price down to $10.
So if I understand correctly, his investment is now worth $2,500, which is 250 shares times $10, which means a loss of $2,500. That's a significant drop. This really highlights the importance of risk management.
Precisely. Alex, in his enthusiasm, perhaps overlooked the importance of diversification. Putting a large chunk of his savings into a single high-risk investment exposed him to significant losses.
Let's take a learning checkpoint here. What could Alex have done differently?
Well, diversifying within the tech sector itself might have been a good start. Instead of putting everything into one startup's IPO, he could have explored tech ETFs, or index funds, which track a basket of tech companies, thus spreading the risk.
Exactly, Taylor. A tech index fund, or ETF, would have provided exposure to a wider range of companies, mitigating the impact of one company underperforming. He could also have considered setting a stop-loss order, which automatically sells a stock when it drops to a certain price, limiting potential losses.
Those are excellent points. Sam, can you elaborate a little on stop-loss orders for our listeners?
A stop-loss order is like setting a safety net. If you set a stop-loss order at $15, for example, your shares would automatically be sold if the price fell to that point, preventing further losses if the stock continues to decline.
So, moving forward from this scenario, what key takeaways should our listeners remember when considering IPOs or tech stocks?
I'd say understanding your risk tolerance is paramount. IPOs and tech stocks can be exciting, but they're not for the faint of heart. Diversification, both within and across sectors, is essential.
I agree, Taylor. And remember, thorough research is crucial. Don't just get caught up in the hype. Look into the company's fundamentals, their financial health, and the competitive landscape.
Excellent advice. So to recap, IPOs offer high growth potential, but also carry high risks, especially in sectors like tech. Diversification and risk management tools like stop-loss orders can help mitigate these risks. Taylor, do you remember what we liken stock ownership to?
Yeah, I think I've got it. It's like owning a tiny slice of a real company, like buying a minuscule portion of that lemonade stand we talked about. So, if the lemonade stand does well, my tiny slice becomes more valuable, right?
Exactly. Sam, anything you'd like to add to that analogy?
It's a good starting point, Taylor. Think of it this way. If the lemonade stand expands and opens more locations because it's doing so well, your initial small investment now represents a part of a bigger, more profitable enterprise. That's how growth works in the stock market.
Excellent. Now let's move on to a slightly more advanced concept, stock splits and their effect on long-term growth. This builds on our previous discussion of stock price fluctuations. Taylor, have you ever heard the term stock split?
I've heard of it, but I'm a bit fuzzy on the details. It sounds like something divides, but I'm not sure exactly what or why.
Great question. Sam, can you break down the concept of a stock split for us?
Sure. A stock split is when a company increases the number of its outstanding shares. Imagine a pizza. Cutting it into more slices doesn't change the total amount of pizza, right? A stock split is similar. It increases the number of shares, but proportionally reduces the price of each share. It doesn't fundamentally change the total value of your investment immediately, much like slicing the pizza into thinner slices doesn't make more pizza appear.
That pizza analogy is helpful. Let's use Sarah's scenario. She initially invests $2,000 in a company with a share price of $50. Let's say she owns 40 shares. The company undergoes 2 stock splits. Sam, how would we calculate the impact of these splits on her investment?
Let's keep it simple. Suppose each split is a 2-for-1 split. For every share Sarah owns, she now owns 2. After the first split, her 40 shares become 80, and the price halves to $25. After the second split, she owns 160 shares, and the price halves again to $12.50. Her total investment value remains approximately $2,000 immediately after the split if we ignore other market dynamics. However, if the price after splits rose to $200, this means the company experienced significant growth, leading to an increase in the stock price even after accounting for the splits.
So if I understand correctly, the splits themselves don't make Sarah richer right away, but they set the stage for potential growth because more shares are available. And if the company performs well, like in Sarah's case where it rises to $200, she benefits greatly with more shares at a higher price. This reminds me of what we discussed about how company performance influences stock prices.
Exactly, Taylor. You've got it. Now let's talk about dividend reinvestment. Let's say Sarah reinvests her dividends at a rate of 5% annually. Sam, how does this contribute to her overall return?
Dividend reinvestment is a powerful tool for long-term growth. Essentially, instead of receiving cash dividends, Sarah uses them to purchase more shares. Over time, this compounding effect, combined with the stock splits and rising share price, can significantly amplify her returns. Even a small percentage reinvested consistently can make a big difference over time.
So, key takeaway here. Stock splits increase the number of shares, dividend reinvestment helps you accumulate more shares over time, and a growing company ideally increases the value of those shares. Combined, these factors contribute to long-term growth potential. Any final thoughts, Sam?
Just to reiterate, Sarah's success stems from a combination of factors: smart investment in a growth-oriented company, the power of stock splits, the magic of compounding through dividend reinvestment, and her patience to hold her investments despite short-term market fluctuations.
How does knowing about different types of stock help me as an investor?
Excellent question, Taylor. Sam, can you elaborate on why understanding various stock categories is important?
Absolutely. Different stock types offer varying levels of risk and potential return, much like savings accounts. Let's start with a simple comparison: common and preferred stock. We touched on this earlier in episode 28, where we wrapped up our discussion on bonds. But let's build on it. Common stock gives you voting rights and potential for higher growth. Think of it like being a full partner in the lemonade stand, having a say in decisions and sharing in the profits if they grow significantly. Preferred stock, on the other hand, typically offers fixed dividends, similar to a consistent interest payment, but usually no voting rights. Imagine it as lending money to the lemonade stand with a guaranteed return, but less say in how it's run.
So if I understand correctly, if I'm looking for potentially higher gains, I might consider common stock. But if I prefer a more predictable income stream, preferred stock might be a better fit.
Precisely. It comes down to your individual investment goals and risk tolerance.
Let's do a quick learning checkpoint. Can you recap the key difference between common and preferred stock, Taylor?
Sure. Common stock gives you voting rights and potential for higher growth, while preferred stock offers more predictable dividends but usually no voting rights.
Perfect. Now let's explore other stock categories. Sam, could you tell us about growth, value, cyclical, and defensive stocks?
Let's use a simple example. Imagine a tech startup developing a new type of phone. That's a growth stock. It carries higher risk but high potential return. Now think of a well-established grocery store chain. It's more of a value stock. It might not grow as quickly, but it's typically more stable. Then we have cyclical stocks, like car manufacturers. Their performance is tied to the economic cycle. Finally, defensive stocks, think utility companies. They tend to perform steadily even during economic downturns.
So if I'm more comfortable with risk, growth stocks might be an option. But if I prefer stability, I might look at value or defensive stocks. And cyclical stocks are more influenced by the overall economy.
Exactly. Now let's take a counterexample. Imagine a luxury car manufacturer. During an economic downturn, fewer people buy luxury cars, making it a cyclical stock. However, a discount grocery store might actually perform better during a recession as people look for cheaper options, making it less cyclical and potentially even a defensive play.
That's a great point, Sam. It's not always black and white. Let's also talk about market capitalization. Large cap, mid cap, and small cap stocks. Sam, can you explain this concept?
Think of it like different sizes of lemonade stands. Large cap companies are the huge, established ones. Think Apple or Coca-Cola. Mid cap companies are medium sized, and small cap companies are the smaller, newer businesses. Each carries a different level of risk.
So, this reminds me of our discussion about diversification. Spreading my investments across different sizes of companies could help manage risk.
Exactly right, Taylor. Diversification is key. Let's dive deeper into different stock types and valuation methods.
We talked about the basics of stocks, like how they represent ownership and the different types, common and preferred. It reminded me of buying a slice of a giant pizza, where common stock gets you a vote on toppings and preferred stock gets you first dibs on the pepperoni.
That's a good analogy, Taylor. We're going to slice that pizza even thinner, looking at growth versus value stocks, market capitalization categories, and even exploring some alternative investments beyond the pizza parlor altogether.
Perfect. Let's start with our next scenario, focusing on growth stock valuation. Sam, can you walk us through how an investor would use DCF, discounted cash flow, analysis to evaluate a growth stock?
Sure. DCF analysis is like predicting the future earnings of a lemonade stand, to borrow from our previous example. You project the lemonade stand's free cash flow. That's the money left over after all expenses and reinvestments over a certain period, say the next 10 years. Then you discount those future cash flows back to today's value using a discount rate, representing the required rate of return. Finally, you add the terminal value, which represents the value of all cash flows beyond the initial projection period. This gives you the intrinsic value, what the lemonade stand or company is really worth.
So if I understand correctly, the discount rate is key. A higher discount rate means future cash flows are worth less today, right?
Exactly. And for growth stocks, projecting future cash flows accurately is especially important, as their value is heavily dependent on expected growth.
Great point. Let's pause here for a learning checkpoint. Taylor, can you recap the main steps of DCF analysis in your own words?
Okay, so first, you project the free cash flow of the company over a set period. Then, you discount those future cash flows back to their present value using a discount rate. Finally, you add the terminal value to capture the value beyond the projection period. The sum of those present values is the intrinsic value.
Excellent. Now, Sam, how does relative valuation fit into this picture?
Relative valuation is like comparing your lemonade stand to others in the neighborhood. You look at similar companies, or comps, and compare their valuation multiples, like price to earnings or price to sales ratios. This helps determine if your target lemonade stand is overvalued or undervalued compared to its peers.
So, if other lemonade stands are selling for 10 times their earnings, and ours is projected to earn $1 per share, a relative valuation might suggest our lemonade stand is worth $10 per share?
Precisely. By combining DCF and relative valuation, investors get a more comprehensive picture. If both methods suggest the company is undervalued, it strengthens the investment case.
Fantastic explanation. This scenario highlights how investors use multiple tools to assess potential investments. Any final thoughts on this, Sam?
Just to emphasize, valuation is an art as much as a science. There's always uncertainty involved in projecting future performance. That's why investors also conduct sensitivity analysis, tweaking key assumptions like growth rates and discount rates to see how they impact the valuation.
Great takeaway. So we've covered DCF and relative valuation, connecting them to the simpler examples we discussed earlier. Taylor, how are you processing all this information so far?
It's clicking, Alex. Thinking about stocks as actual pieces of a company, like my tiny slice of apple, makes it much more real than just numbers on a screen. I'm also starting to see why diversification is important, especially after we talked about the risk of a company going bankrupt.
Excellent point, Taylor. Diversification is key. And now let's dive deeper into stock categories and explore more advanced investment opportunities.
Glad to hear Taylor's finding it helpful. Building on that foundation, let's explore different stock categories that can help diversify a portfolio.
Sounds good. Let's start with the scenario, the turnaround investment in an emerging market. It's a complex one, so let's break it down. Sam, what are the key initial steps an investor should take when considering such an opportunity?
The first step is fundamental analysis. We examine the company's financials, profitability, debt, cash flow, but in a turnaround situation, we also scrutinize the restructuring efforts, looking for signs of sustainable recovery. This might involve examining new management strategy, cost-cutting initiatives, or efforts to increase revenue. Think of it like a doctor diagnosing a patient. You need to understand what went wrong and if the treatment is working.
So, if I understand correctly, it's not enough to just look at the current numbers. We need to look at the trend and the story behind the numbers. But how do we assess the story, the management team, and their turnaround plan, for instance?
Exactly, Taylor. Evaluating management is crucial. We examine their track record, experience in turnarounds, and the feasibility of their plan in the current market. We also look for transparency. Are they being honest about the challenges and their proposed solutions? Due diligence here involves researching their past performance, reading industry analysis reports, and understanding the competitive landscape.
To give our listeners a practical example, imagine a clothing retailer struggling with declining sales. Their turnaround plan might involve closing underperforming stores, investing in e-commerce, and refreshing their product line. Analyzing this would mean examining their online sales growth, the cost savings from store closures, and customer response to the new product line. All quantitative data points that tell a story.
That's helpful, Alex. The quantitative data makes it more concrete, but our scenario is in emerging markets. Doesn't that add another layer of complexity? What about political instability or currency fluctuations?
You're absolutely right, Taylor. Emerging markets offer higher growth potential, but they also come with higher risks. We need to consider political risk, the chance of government intervention that could harm our investment. We also have to analyze currency exchange rates. Changes in the relative value of currencies can impact our returns. For example, if the local currency depreciates against the dollar, our profits will be worth less when converted back.
Let's recap. When considering a turnaround investment, particularly in an emerging market, we analyze the company's fundamentals, evaluate the management team and their turnaround plan, and account for the additional risks associated with the emerging market, including political and currency risks.
This is a lot to absorb, but it's starting to make sense.
Thanks, Sam and Taylor. This was a great introduction to evaluating turnaround investments. We'll definitely revisit this topic in future episodes. So far, we laid the groundwork for understanding stocks, what they are, why companies issue them, and how stock prices fluctuate. Today, we're diving deeper into the psychological aspects of investing.
Thanks, Alex. I'm really excited to unpack this. Last time, learning about how stocks represent actual ownership in a company really clicked for me. Now I'm curious about how our minds can affect our investment decisions.
Excellent point, Taylor. Understanding the psychology of investing is arguably as important as understanding financial statements. We'll be focusing on how emotions and biases can influence our choices, sometimes for the worse.
So let's start with a real-world scenario. Imagine you're scrolling through social media and see everyone talking about a stock that's skyrocketing, a meme stock, let's say. Suddenly, you're gripped by the fear of missing out, or FOMO. What happens next, Taylor?
Oof, I can relate to that feeling. I'd probably be tempted to jump in, thinking I need to buy now before I miss out on huge profits. This reminds me of the lemonade stand example from last time. If everyone's lining up for lemonade, you want to be selling it, right? But in this case, it feels more like panic buying than strategic investing.
Exactly. That's FOMO at play. It's a powerful emotional bias. In our scenario, the rapid price surge is driven by social media hype, not necessarily by sound fundamentals, like the actual financial health and potential of the company.
Sam, could you elaborate on fundamentals for our listeners?
Certainly. Fundamentals refer to the underlying factors that affect a company's intrinsic value. Think of things like revenue, earnings, debt levels, and the company's overall position within its industry. They paint a picture of the company's long-term health and potential for growth, as opposed to short-term market buzz.
So if I understand correctly, even if a stock price is soaring, weak fundamentals could indicate that the price is inflated and unsustainable, like a bubble that's about to burst.
Precisely. Think of a dot-com bubble situation. Lots of hype, soaring valuations, but ultimately, many companies lack the solid foundations to support those prices. Our scenario with the meme stock demonstrates a similar principle on a smaller scale.
This is a crucial point. It's easy to get swept up in market excitement, but strong fundamentals should always underpin your investment decisions. This brings us to our learning checkpoint. How do you, Taylor, think you could identify and counter the influence of FOMO in your own investment decisions?
Well, I think recognizing FOMO for what it is, an emotional response, not a rational analysis, is the first step. Then, I'd try to focus on researching the company's fundamentals, looking at their financial statements, understanding their business model, like we talked about last time with the lemonade stand, instead of just following the crowd.
Excellent. Having a predefined trading plan can also be incredibly helpful. It acts like a roadmap, helping you stick to your investment strategy even when emotions run high.
And remember, diversification or spreading your investments across different assets can also help mitigate risk. If one investment underperforms, others may balance it out. So we've discussed FOMO, the importance of fundamental analysis, and touched upon trading plans and diversification. We'll explore these concepts in more detail in future episodes. Next, we're going to explore how our own thinking can influence our investment decisions, sometimes in ways we don't even realize. Sam, can you tell us about confirmation bias and how it plays out in the world of investing?
Absolutely. Confirmation bias is our tendency to favor information that confirms our existing beliefs, while disregarding information that challenges them. Let's say you're convinced a particular tech company is going to take off. You might find yourself reading only positive articles about the company while ignoring analyst reports that highlight potential risks.
So, even if there's evidence suggesting the company isn't doing so well, I might subconsciously filter it out because I'm already invested in the idea of its success.
Precisely. It's like wearing rose-colored glasses. And this can lead to bad investment decisions, like holding on to a losing stock for too long because you're clinging to the belief that it will eventually rebound.
That makes a lot of sense. So, if I'm hearing you correctly, Sam, it's almost like we build a narrative in our minds and then seek out evidence to support that story, even if the story isn't entirely accurate.
Exactly. A simple example. Imagine you bought a stock based on a prediction that the economy would grow rapidly. If the economy starts showing signs of slowing down, you might downplay those indicators and focus on any remaining signs of growth, reinforcing your initial belief.
This reminds me of the different stock types we discussed last time, common and preferred. If I strongly believe in a company's long-term growth, even if its preferred stock is performing better in the short term due to fixed dividends, confirmation bias might lead me to double down on common stock, hoping for higher returns despite the higher risk, right?
That's a great application, Taylor. And another related bias is anchoring, which is the tendency to rely too heavily on the first piece of information we receive, even if it's not the most relevant. For example, if you first heard about a stock when it was trading at $50, you might be anchored to that price, making it harder to objectively evaluate the stock when it's trading at $100 or $25.
So, even if the company's fundamentals have changed significantly, the initial price we saw acts as a mental anchor, influencing our perception of value.
So if I understand correctly, confirmation bias makes us look for information that supports our existing beliefs, and anchoring makes us fixate on initial information, both potentially leading to poor investment decisions.
You got it. The key takeaway here is to be aware of these biases and to actively seek out diverse sources of information. Don't just read articles that agree with you. Challenge your own beliefs, consider alternative viewpoints, and be prepared to adapt your investment strategies as new information becomes available.
Great advice, Sam.
I'm really starting to grasp the fact that when it comes to investing, emotions play a much bigger role than I initially thought.
Absolutely, Taylor. Understanding the psychology of investing is just as critical as understanding financial statements.
Exactly. Let's see what's going on when an investor holds on to a losing stock, hoping it will bounce back. A classic example of loss aversion. Taylor, can you relate to that feeling of not wanting to sell something at a loss?
Oh, absolutely. I remember buying a dress on sale, only to find out later it was marked down even further. I kept it in my closet for ages, even though I didn't really like it anymore, just because I didn't want to admit I'd made a bad purchase. It's that same sunk cost fallacy we talked about before, isn't it? Throwing good money after bad?
Precisely. Loss aversion magnifies that sunk cost fallacy in investing. The pain of realizing a loss can be so strong that it leads to irrational decisions, like holding on to a declining stock, hoping for a miracle. This is where having a clear exit strategy becomes crucial.
Let's unpack that. An exit strategy is essentially a predetermined plan for when to sell a stock, regardless of whether you're making a profit or a loss. It helps take emotion out of the equation.
So if I understand correctly, setting an exit strategy before I even buy a stock would help me avoid those emotionally driven decisions influenced by loss aversion. Like, if this stock drops by 15%, I'll sell, no matter what.
Exactly. Think of it as a safety net. It protects you from clinging on to losing positions for too long, potentially exacerbating losses. And it's particularly important in volatile market conditions. This ties into the topic of herd behavior.
Right, herd behavior, the tendency to follow the crowd, even if it's against your better judgment. Example is when an investor panic sells along with everyone else during a market downturn. Sam, what are the typical consequences of this type of behavior?
Herd behavior often amplifies market swings. Imagine a flock of birds suddenly changing direction. The entire flock moves dramatically. In the stock market, this can lead to steep declines during sell-offs, as everyone rushes to exit simultaneously. This creates a negative feedback loop, further fueling fear and panic.
So, even if a stock might have been a good long-term investment, the fear of everyone else selling could lead me to make a bad decision based on short-term panic.
Exactly. That's why understanding your own risk tolerance is so important. Knowing how much volatility you can comfortably handle helps you resist the urge to follow the herd.
Let's recap. We've talked about loss aversion, the importance of exit strategies, and the dangers of herd behavior. These psychological factors can significantly impact investment decisions, often leading to less than optimal outcomes.
This conversation has really highlighted for me how much our own minds can be our biggest obstacles in investing.
Absolutely. Recognizing these psychological pitfalls is the first step toward navigating the markets more effectively.
This is the end of the first episode in the series of episodes on the topic of stocks. We'll be back with more entertaining discussions. Till then, invest safely in sound stocks.
That's all for this episode. If you found it valuable, don't forget to subscribe to the podcast. For more insights, you can join my newsletter at savesimplesound.com. If you would like personalized guidance, you can reach out to us at savesimplesound.com/contact. Until next time, take care and bye for now.